Every legend has a day zero, a moment where the world stops being a playground and starts being a battlefield. For Michael Marcus, that day was in 1972. He wasn't a titan of Wall Street yet. He was just a 25-year-old psychology student who had just done the unthinkable. He had incinerated his father's legacy and his mother's life savings in a single catastrophic trade. He didn't just lose money that day. He lost his identity. But from the ashes of that total wipeout, Marcus built something that would eventually rule the global markets, a 20-point blueprint that turned a humbled student into an $80 million market wizard. This isn't just a story of wealth, it is a masterclass in the psychological warfare of speculation. Today, we are opening the vault. Welcome to the Growth Archive. Today, we decode the 20 pillars of the Michael Marcus blueprint. The anatomy of the expert trap, why intellectuals fall for fools. The first major lesson in the life of Michael Marcus is the expert trap. This is a phenomenon that disproportionately affects high achievers and intellectuals. Marcus was a Phi Beta Kappa graduate of Johns Hopkins and a doctoral candidate in psychology. He was a man trained to look for patterns, to respect authority, and to believe that complex problems have complex solutions. When he met a man named John, a friend of a friend who claimed to have a secret sauce for doubling money every 2 weeks, Marcus didn't see a red flag. He saw a shortcut that matched his own high-speed intellectual ambitions. The expert trap is predicated on the aura of certainty. In the financial markets, the most dangerous people are those who speak with 100% conviction. To a novice, certainty feels like competence. John spoke with the authority of someone who had decoded the matrix of the commodities market. Marcus, despite his academic pedigree, was a novice in the world of hard assets. He made the classic mistake of outsourcing his thinking to someone who appeared to have a higher level of specialized knowledge. In the professional world, we are taught to trust experts, doctors for medicine, lawyers for law, and professors for science. But the market is a chaotic system where past performance does not guarantee future results. When Marcus handed over his father's life insurance money to John, he was committing the cardinal sin of speculation, the abdication of personal responsibility. He wasn't trading, he was participating in a follow-the-leader cult. The psychology behind the expert trap is rooted in the social proof principle. If someone looks the part, talks the part, and claims results, our brains are hardwired to bypass critical analysis to save energy. Marcus learned, through the loss of his first stake, that in the market, an expert is often just a person who hasn't been humbled by a black swan event yet. This lesson formed the bedrock of his later independence. He realized that to survive, he had to become his own expert. He had to build a system that was so robust it didn't require the validation of a guru. The expert trap taught him that if a strategy sounds too good to be true, like doubling your money every fortnight, it isn't a strategy, it's a mathematical impossibility masquerading as opportunity. But as Marcus was about to learn, trusting the wrong person wasn't only half the problem. The real danger wasn't just who he was listening to, it was the type of money he was gambling with. If you think losing your own savings is hard, wait till you see the psychological toll of losing a dead parent's legacy. If you're tired of the gurus and want to see the raw, unfiltered truth behind how market legends are actually made, make sure to hit that subscribe button and join the archive. We don't do hype here, we do history. The emotional stake, trading with sacred capital. The second point involves the nature of the capital itself. Marcus didn't just start with spare cash. He started with $3,000, a significant sum in the late 1960s, derived from his deceased father's life insurance policy. This is what professional psychologists call high-stakes emotional capital, or sacred money. In the world of professional trading, money must be viewed as units of risk or tools for a job, much like a carpenter views a hammer. If the carpenter becomes emotionally attached to the hammer, he cannot use it effectively.
However, for Michael, that $3,000 represented his father's legacy, his father's protection, and a final link to a man he had lost far too early. When you trade with money that you cannot afford to lose, not just financially but emotionally, your decision-making process is hijacked by the amygdala. When a trade goes slightly against you, and that trade represents a parent's legacy, you don't see a market fluctuation, you see a personal insult. You see the erasure of your history. This leads to two fatal behaviors. The deer in headlights, you become paralyzed by the fear of being wrong, so you fail to cut your losses when they are small. And revenge trading, you try to force the market to give back what it stole from you, leading to over-leveraging and desperate moves. Marcus's early failures were exacerbated by the weight of this money. He wasn't just losing dollars, he was losing a piece of his father. This created a cycle of hope and prey trading. He would enter a position, the market would tick down, and instead of exiting based on a logical stop-loss, he would stay in the trade because the pain of realizing the loss was too great to bear. Eventually, he realized that to be a market wizard, he had to detach the value of the money from the value of his self-worth. He had to learn to treat the capital as a neutral resource. This is why many successful traders suggest starting with disposable income, not because they don't value money, but because the brain needs to be able to make cold, calculated decisions without the interference of emotional ghosts. The emotional stake lesson taught Marcus that the most important part of a trading plan isn't the entry or the exit, it is the psychological state of the person pulling the trigger. Most people think that losing this emotional capital would be the ultimate rock bottom, but for Marcus, the real trap was actually a massive win, a win so big and so effortless that it almost guaranteed his eventual total destruction. Understanding the psychology of sacred money is the first step towards professional discipline. If you're finding value in these deep dives, drop a like on this video. It helps the algorithm find other serious traders who need to hear this message. The curse of beginner's luck. Luck as a poison. The third and perhaps most insidious lesson was Marcus's initial success. After losing his first two small stakes, he took his remaining $700 and bought corn during the 1970s Southern corn leaf blight. Within a few months, that $700 turned into $30,000. For a young man in his early 20s, this was a life-altering sum. It was also the worst thing that could have happened to him. Beginner's luck is a poison because it reinforces bad habits. Marcus made $30,000 without a system, without risk management, and without a deep understanding of commodities. He made it because he happened to be long on a crop that caught a disease. Because the reward was so high, his brain signaled that he was a natural. This is known as outcome bias, the tendency to judge a decision by its eventual outcome instead of the quality of the decision at the time it was made. A trader who makes 10% a year through a disciplined process is 1,000 times more valuable than a trader who makes 1,000% in a month through a lucky break. The lucky trader will eventually give it all back to the market because they don't know how they made it and therefore don't know how to keep it. Marcus's journey from luck to skill required him to unlearn everything the $30,000 corn trade taught him. He had to dismantle his ego and start from zero, learning the Secota protocol of trend following and risk control. This total wipeout was the necessary death of the old Michael Marcus. But what rose from the ashes wasn't just a better trader, it was a mathematical machine. To understand how he went from $0 to $80 million, you have to see the exact three-part system he developed to ensure he would never be lucky again. We are just scratching the surface of the Michael Marcus story. To get the full 20-point breakdown of his entire career and the checklists he used for his multi-million-dollar trades, check the link in the description or stay tuned for the next chapter in this series. Synergy, the final evolution. The transition from a lucky gambler to a market wizard is a path paved with the corpses of those who could not learn these three lessons. Marcus's ability to survive the Plywood Massacre and return to the charts with a humble, student-like mindset is what separates him from the thousands of other traders who were wiped out by the Nixon-era volatility.
He realized that the market's job is to humiliate the proud and reward the disciplined. By the time he reached his peak in the 1980s, trading millions of dollars in the German mark and Saudi rial, he was no longer the boy following John. He was a man who had mastered his own mind, understanding that the greatest enemy any trader faces is not the limit-down move on the screen, it is the reflection in the mirror.
Marcus felt invincible. He decided to move his entire capital and $20,000 borrowed from his mother into plywood futures. This was not a trade. It was a total commitment of his family's financial future based on a sure-thing tip regarding an upcoming shortage. The Plywood Massacre is a case study in concentration risk. In professional trading, your survival is dictated by your ability to stay in the game. By putting every dollar into a single commodity, Marcus removed his margin of safety. He was no longer trading probabilities, he was gambling on a binary outcome. If he was right, he would be a millionaire. If he was wrong, he would be destitute. The catalyst for the disaster was Richard Nixon's price controls. Marcus expected the shortage to drive prices to the moon, but the government's artificial ceiling on prices caused the market to invert. When the news broke, the price of plywood didn't just drift lower, it collapsed. This event highlights the black swan theory in trading, the idea that the most devastating events are the ones that are impossible to predict. Marcus had accounted for supply and demand, but he had not accounted for the heavy hand of government intervention. Psychologically, the Plywood Massacre was a shattering of the ego. Marcus had to face the reality that he had not only gambled away his father's legacy, but also put his mother's retirement at risk. This is the point of no return for most traders. Most people, faced with this level of shame and financial ruin, would walk away and never look at a ticker tape again. But for Marcus, this was the tuition of the markets. He realized that tips were a poison, and that without a strategy to handle being wrong, he was simply waiting for his turn to go broke. But as devastating as the financial loss was, it wasn't the most terrifying part of the plywood trade. The real horror began when Marcus tried to exit the position and realized the doors to the market had been locked from the outside. To understand the true trauma of 1972, you have to understand the phenomenon of limit down. If you're finding this deep dive into the psychology of failure useful, make sure you're subscribed to the Growth Archive. We don't just tell stories, we dissect the mechanics of success so you can build your own legend. The limit down trauma, the prison of illiquidity. In the futures markets, there are daily price movement caps known as limits. If a price moves too far in one direction, the exchange halts trading for the day to prevent a total panic. While this sounds like a safety feature, for a trader on the wrong side of a move, it is a nightmare. This is the limit down trauma. When plywood hit limit down, Marcus was effectively trapped in a burning building. He wanted to sell, he was willing to take a loss, but because the price had hit the floor, there were no buyers. In a liquid market, you can always exit for a price. In a limit market, your net worth becomes a theoretical number that you watch tick lower and lower every morning as the market opens at a new, lower limit, only to freeze again instantly. This taught Marcus the vital importance of liquidity and exit strategy. A trader is only as good as his ability to get out of a position. Marcus sat in the brokerage office for days, staring at the screen, watching his mother's $20,000 and his own $30,000 vanish into the void. He was a prisoner of his own position. This created a lasting psychological scar that would later define his risk-first mentality. He realized that the exit is more important than the entry. The limit down trauma also introduced Marcus to the concept of market physics. He realized that when everyone is trying to exit through the same small door at the same time, the door breaks. This influenced his later work in the German mark and Saudi rial, where he sought out massive liquid global markets where he could move millions of dollars without getting trapped. He vowed that he would never again put himself in a position where he was at the mercy of the exchange's rules. From that day on, Michael Marcus became a volatility manager rather than just a trend follower. Most traders would have stayed in that brokerage office and withered away,
But Marcus did something that 99% of people are too proud to do. He admitted he was a fool and went looking for a master. And the man he found would change the course of financial history forever. If this breakdown is helping you see the markets in a new light, hit that like button. It tells the YouTube algorithm that the Growth Archive is providing the kind of high-level education that serious traders actually need. The power of mentorship. The Selective Protocol. Broke, humbled, and desperate, Marcus took a job as a research analyst. It was here that he met Ed Selective, the man who would become his market sensei. This meeting represents the most important pivot in Marcus's life, the transition from an opinion-based trader to a system-based trader. Selective was a pioneer of computerized trend following. While everyone else in the 1970s was trying to guess the weather or read tea leaves, Selective was looking at moving averages. He taught Marcus that the trend is your friend until the end when it bends. This was a revolutionary shift. Marcus had spent years trying to be right about the world. Selective taught him that being right is irrelevant. What matters is being on the right side of the price. Mentorship allowed Marcus to skip decades of trial and error. Selective provided the psychological guardrails that Marcus lacked. He taught him that the market is a river and the trader is a surfer. You don't tell the wave where to go, you just learn how to ride it. Selective's most famous exercise for Marcus was the hand-drawn chart. He forced Marcus to physically plot the prices of commodities every day. This was a form of meditative discipline designed to remove the ego and replace it with a cold, analytical observation of momentum. Under Selective, Marcus learned the law of objective reality. He realized that his previous failures were caused by fighting the tape, trying to prove he was smarter than the market. Selective's protocol was simple. Find a trend, get on it, and stay on it until the price tells you otherwise. This mentorship was the hard reset Marcus needed. It turned the psychology student into a market technician. Without Selective, Michael Marcus would have been just another tragic story of a smart kid who lost it all. With Selective, he became the blueprint for the modern market wizard. But the Selective protocol wasn't just about drawing lines on a paper. It was about a secret trifecta that Marcus would eventually use to conquer the currency markets of Germany and Saudi Arabia. If you want to know how he turned these lessons into $80 million, you have to see the math behind his first sacred position. The story of Michael Marcus is just one of many we are decoding here. To get our exclusive Trader's Blueprint based on these legendary lives, click the link in our description and join the Growth Archive mailing list today. The synthesis of disaster and discipline. The combination of these 3 points, the massacre, the trauma, and the mentorship, creates the hero's journey of the speculator. The massacre was the death of the old self. The limit-down trauma was the purgatory where Marcus had to sit with his mistakes, and the mentorship was the rebirth. Most people seek mentorship because they want to make money. Marcus sought mentorship because he realized he didn't know how not to lose money. This is a subtle but profound distinction. A trader who focuses on making money is focused on the reward. A trader who focuses on not losing money is focused on the process. Selective shifted Marcus's gaze from the pot of gold to the path. This era also taught Marcus the value of humility. In the 1970s, many traders were loud, brash, and aggressive. Marcus, through his failures, became quiet and observant. He realized that the market is a giant machine for humbling people. If you come to the market with an ego, the market will take your money to pay for your education. If you come with humility and a system, the market will eventually pay you a fortune. The Selective protocol also introduced the concept of mechanical trading. Marcus began to understand that human emotions are the enemy of profit. Your brain wants to sell when you're scared and buy when you're greedy. A mechanical system, like the 50-day and 200-day moving averages, acts as a prefrontal cortex for your trading, making the logical decisions that your emotional brain is too compromised to make. The geopolitical backdrop of the 1972 to 1974 transition. To understand why these lessons took root so deeply, we must look at the chaos of the 1972 to 1974 period. This was not just a bad time for Marcus, it was a bad time for the world. The gold standard had recently been abolished, the oil crisis was beginning to simmer, and the Nifty 50 stock bubble was bursting. Marcus was learning to trade in an environment where the old rules of value investing were being incinerated by inflation. This forced him to become a global macro tactician. He realized that he couldn't just look at plywood, he had to look at interest rates, currency fluctuations, and international treaties. His failures in plywood were a direct result of ignoring the macro hand of the government. This environment was the perfect pressure cooker for a wizard. It refined his senses. By the time he started trading for Commodities Corporation, he had a battle-hardened perspective. He knew what it felt like to be broke. He knew what it felt like to be trapped. And most importantly, he knew that he had a mentor who had survived it all. This gave him the conviction to hold on to massive winning trades later in his career. While others would take a small profit and run, Marcus, remembering the pain of his losses, would hold on to his winners until they became life-changing.
The psychological rewiring of Michael Marcus. The most profound elaboration of this period is the rewiring. Marcus had to stop thinking like a PhD student and start thinking like a predator. In academia, you were rewarded for being nuanced and complex. In the market, you were rewarded for being decisive and disciplined. He had to move from a state of cognitive dissonance, where he made excuses for his losing trades, to a state of radical acceptance. If the price was going down, he was wrong, period. There was no room for, "but the supply report says," or "but the tipster said." This shift in consciousness is what allows a trader to manage millions. You have to be able to hit the sell button on a losing trade with the same emotional indifference as if you were ordering a cup of coffee. The limit down trauma was the catalyst for this indifference. Once you have seen your net worth stay frozen for days while you are powerless, a 1% or 2% loss feels like a blessing. It changed his pain threshold. Marcus became comfortable with the discomfort of the market. He learned to love his stop losses because they were the only things that kept him from the limit down prison. Conclusion: the foundation of the $80 million run. When Michael Marcus finally emerged from his Psychota apprenticeship, he was no longer the boy who gambled his father's insurance money. He was a professional. He had integrated the pain of the Plywood Massacre and the limit down trauma into a cohesive defense-first strategy. He understood that liquidity is life. If you can't get out, you don't get in. The system is the savior. Your opinions don't matter, the moving average does. Mentorship is the shortcut. Learn from the ghosts of those who failed before you. These 3 points, 4, 5, and 6, are the reason Michael Marcus was able to handle the massive volatility of the 1980s. When the German mark was swinging wildly and the Saudi rial was under pressure, Marcus didn't panic. He had already been through the fire. He knew that as long as he followed the Psychota protocol, he was safe. He had replaced his hope with process. And in the world of high-stakes speculation, that is the only way to become a wizard. Point 7. The trend is king, the sovereignty of price. Under the mentorship of Ed Psychota, Michael Marcus had to unlearn the most dangerous habit in academia, the need to be right. In the world of PhDs and psychology, you are rewarded for your why. In the markets, your why can lead you to the poorhouse. Psychota hammered home a singular, brutal truth. The trend is king. This is the foundational law of the market wizard philosophy. It posits that the market price is the ultimate source of truth, regardless of what the news, the experts, or your own logic might dictate. Most amateur traders suffer from value bias. They see a stock or a commodity drop in price and think, it's cheap, I should buy it. Marcus learned that cheap can always get cheaper.
The trend is king rule taught him that a market moving upward has a higher mathematical probability of continuing upward than a market that is trying to find a bottom. This is the physics of the market, inertia. Once a trend is established, it takes a massive amount of counterforce to stop it. Marcus learned to stop fighting the river. If the price was moving up, he was a buyer. If the price was moving down, he was a seller or a spectator. He realized that the sovereignty of price meant that if the market disagreed with his fundamental research, the market was right and he was wrong. This shift removed the emotional friction from his trading. He no longer felt stupid when a trade went against him. He simply recognized that the king had changed direction and it was his job to follow the new monarch. But how do you know when a trend is actually a trend and not just a fake-out designed to trap retail traders? Marcus didn't guess. He used a red line in the sand, a single mathematical filter that he called the difference between a bull market and a bear market. If you're serious about escaping the noise of modern financial media and building a legacy of your own, found your home. Subscribe to the Growth Archive and turn on notifications. We are documenting the blueprints of the world's most successful humans, one chapter at a time. Point 8. The 200-day filter, the definitive line of likelihood. To protect himself from his own impulses, Marcus adopted what many consider the most important technical rule in the history of trend following, the 200-day moving average filter. This is a cold, hard mathematical calculation of the average closing price over the last 200 trading sessions. For Marcus, this was not just an indicator, it was a religious boundary. The rule was absolute. Never buy a market that is trading below its 200-day moving average. Why is this so powerful? Because the 200-day MA represents the average cost basis of the long-term institutional investors. When a price is below this line, the big money is under pressure. They're looking to sell into any rally to break even. This creates overhead resistance. Conversely, when a price is above the 200-day line, most participants are in profit. They aren't panicked. They're looking to add to their positions. Marcus realized that by only trading above the 200-day line, he was essentially saying, I will only play in games where the wind is at my back. This filter prevented him from the heroic but foolish attempt to catch falling knives. It kept him out of the devastating bear markets of the 1970s. This filter turned Marcus from a scattergun trader into a sniper. He stopped looking at thousands of charts and started focusing only on the stage 2 uptrends where the momentum was undeniable. Most people see a chart and see random jagged lines, but Marcus was taught to see potential energy. He discovered that markets, like physical objects, need to rest and base before they can explode. And if you know how to spot this quiet period, you can enter a trade right before the million-dollar move happens. If this level of detail is helping you understand the inner game of professional trading, hit the like button. Your support helps the Growth Archive reach more people who are tired of the surface-level advice found everywhere else on YouTube. Point 9. The basing concept, the coiled spring of profit. Marcus learned that the most explosive moves in market history don't start from a peak, they start from a base. A base is a period of weeks, months, or even years where a market moves sideways in a tight range. To the untrained eye, a base looks boring. To Michael Marcus, a base looked like a coiled spring. The psychology of a base is equilibrium. It's a period where the supply of a commodity and the demand for it are perfectly matched. However, underneath the surface, accumulation is happening. The weak hands, retail traders, are getting bored and selling, while the strong hands, institutions, are slowly and quietly buying up every available contract. Marcus looked for the breakout from this base. When the price finally punched through the top of that sideways range, it signaled that the demand had finally overwhelmed the supply. Because the market had been resting for so long, the resulting move was often violent and long-lasting. This is how he identified his legendary trades in the German mark and the Saudi rial. He didn't chase volatile markets, he found quiet markets that were about to become loud. This concept taught him the value of strategic patience. He learned that the real money isn't made in the trading, it's made in the waiting. But even with the perfect chart and the perfect base, Marcus had one more secret to mastering his psychology. He didn't just look at digital screens, he used a slow analog method that forced his brain to feel the market's heartbeat. This is the discipline that separated the wizards from the amateurs. The Growth Archive is more than a channel, it's a repository of success. If you want to dive deeper into these specific checklists Michael Marcus used, click the link in the description to join our community and get access to exclusive breakdowns we don't share anywhere else.
Point 10. The hand-drawn discipline, tactile momentum. In the 1970s, as early computers began to appear, Ed Secoda gave Michael Marcus a seemingly primitive task: draw your charts by hand. Every evening, Marcus would take out large sheets of graph paper and manually plot the daily high, low, and close of the markets he was watching. This was not an exercise in drafting, it was an exercise in neurological conditioning. When you hand draw a chart, you are forced to engage with the data at a much slower pace than when you flick through digital screens. You feel the weight of a $2 drop in gold. You see the struggle of the price to stay above a support line as your pencil moves across the paper. This discipline removed Marcus from the instant gratification loop that destroys most traders. It turned him into an observer of flow. By physically drawing the 50-day and 200-day moving averages, he could see them bending and curving in real time. He developed an intuitive sense of market energy. If a price was moving up, but he felt his hand drawing smaller and tighter candles, he knew the momentum was drying up before a digital indicator could tell him. The hand-drawn discipline was Marcus's Zen practice. It kept him grounded in reality. It prevented him from over-trading. If he had to draw 50 charts by hand every night, he only chose the 50 that truly mattered. This led to hyper-selectivity. He only traded the sacred positions, the ones that were so beautiful and so obvious that they were worth the effort of drawing them by hand. The synthesis, the mechanical evolution. When you combine points 7 through 10, you see the birth of a systematic wizard. Trend is king gave him his direction. The 200-day filter gave him his safety. The basing concept gave him his entry. The hand-drawn discipline gave him his temperament. This quartet of rules solved the psychological problems that plagued Marcus in his early years. He no longer had to wonder if he should buy. He simply checked his filter. He no longer had to hope for a win. He looked for a base. He no longer felt panicked by daily fluctuations because he was physically connected to the long-term flow of the chart. This was the era where Marcus transitioned from a psychology student to a market technician. He realized that the human brain is not designed for trading, it is designed for survival. To trade successfully, you have to create a secondary brain, a system of rules and disciplines that override your natural instincts. The 200-day filter and the hand-drawn charts were that secondary brain. The historical impact of analog discipline. During the 1970s, the Nifty 50 bubble burst and the U.S. economy entered a period of brutal stagflation. Most investors were lost because the fundamental rules of the 1960s, buying good companies and holding them forever, stopped working. But Marcus, however, thrived. Why? Because he didn't care about the goodness of a company or the logic of the economy. He cared about the trend.
While others were losing 50% of their portfolios, holding blue-chip stocks that were below their 200-day moving averages, Marcus was sitting on the sidelines in cash or shorting the market. His basing concept allowed him to find the few commodities, like gold and sugar, that were actually in bull markets. While the rest of the world was in a recession, the commodities market was in a supercycle. Marcus's analog discipline allowed him to spot these breakouts before the general public even knew they were happening. He was early to the greatest commodity bull market in history because he was willing to do the boring work of drawing charts by hand, while others were looking for hot tips in the newspaper. The psychology of the sacred position. Marcus began to refer to certain trades as sacred positions. These were trades where the trend, the filter, and the base all aligned perfectly. By using these 4 points, 7 through 10, he learned to ignore 95% of market activity. This is the hardest lesson for any trader, the lesson of not trading. Most people feel that if they aren't clicking buttons, they aren't working. Marcus learned that working as a trader means waiting. It means drawing your charts every night, seeing that nothing is in a base, seeing that everything is below the 200-day MA, and having the discipline to do absolutely nothing. This selective aggression is what allowed him to eventually manage hundreds of millions for Commodities Corporation. He wasn't a day trader tossing coins, he was a predator waiting for the perfect prey. When the German mark finally broke out of its multi-year base in 1985, Marcus was ready. He hadn't wasted his mental capital on 100 small, mediocre trades. He was fresh, he was liquid, and he was disciplined.
Conclusion: from pencils to millions. Michael Marcus's success was not a result of a secret algorithm. It was a result of his willingness to be bored. He embraced the king trend, respected the 200-day line, waited for the base, and used the hand-drawn pencil to etch these truths into his subconscious. He proved that in a world of increasing complexity, simplicity is the ultimate sophistication. By narrowing his focus to these 4 mechanical points, he removed the expert trap and the emotional stake that had nearly destroyed him in 1972. He was no longer a boy looking for his father's legacy, he was a man building his own. He was now ready for the next level, the trifecta. He had the technicals mastered, now he had to reintegrate the fundamentals and the market tone to create the most powerful trading system the world had ever seen. But the foundation, the graph paper, and the 200-day line would remain the bedrock of his $80 million run until the day he retired. Point 11. The trifecta requirement, the convergence of 3 worlds. If points 1 through 10 were about Michael Marcus's survival and basic training, point 11 is where he achieved mastery. Marcus realized that technical analysis alone was a map, but not the terrain. Fundamental analysis alone was a story, but not the timing, and psychology alone was a state of mind, but not an action. To solve this, he developed what he called the trifecta. He would only enter a sacred position when 3 distinct roads converged at a single point in time. The first road was fundamentals. Marcus would look for a supply-demand imbalance so severe that the price had to move. He wasn't looking for good news, he was looking for a catastrophic shortage or an overwhelming surplus. The second road was technicals. He needed to see a base breakout and the price trading above the 200-day moving average. The third road was market tone, the most elusive and powerful element. The trifecta served as a filter for his hyper-selectivity. Most traders take trades that have good charts. Marcus took trades where the chart said buy, the USDA report said shortage, and the market's reaction to news said strength. By requiring all 3, he drastically reduced his overtrading. He might wait 6 months for a single trifecta alignment, but when it happened, his confidence was so high that he could bet with massive size. He realized that wealth is not built by being in the market every day. It is built by waiting for the rare moments when the universe provides a sure thing alignment.
But even within this trifecta, there was one element that Marcus valued above all others, a secret sauce that allowed him to see the future of a price move before it even happened. It wasn't about the data, it was about the market's soul. If you're building your own trifecta for life and wealth, you found the right archive. Subscribe to the Growth Archive and join a community that values deep systems over quick wins. Point 12. The market tone secret, the psychology of reaction. Market tone is perhaps Michael Marcus's greatest contribution to the art of speculation. He defined tone as the reaction of the market to news. It is the bridge between the data and the dollar. Marcus discovered that what the news says is irrelevant. What matters is how the participants behave in response to that news. He looked for bullish divergence. Imagine a scenario where the Federal Reserve announces a surprise interest rate hike, historically a very bearish event for stocks and commodities. In a weak market, prices would crash, but in a market with strong tone, the price might dip for 10 minutes and then rally to finish the day at a new high. Marcus interpreted this as the ultimate go signal. It meant that every person who wanted to sell had already sold. The bad news was already priced in, and yet the market refused to go lower. This exhaustion of sellers was the signal that a massive bull run was imminent. Conversely, if a market received incredibly good news but failed to rally, Marcus knew the trend was over. This is the exhaustion of buyers. By reading tone, Marcus was able to exit the German mark at the near top in the late 1980s. He didn't wait for the trend to bend. He saw the tone souring, and he got out while the experts were still bullish. Point 13. Risk management as a priority, the 5% survival law. After the 1972 Plywood Massacre, Marcus became a risk-first trader. He realized that the market is a game of probability, not of certainty. Therefore, the only thing a trader can truly control is how much they lose. He adopted the 5% rule. He would never, under any circumstances, risk more than 5% of his total equity on a single trading idea. To understand the math of this, we look at the risk of ruin. If you risk 20% per trade, a string of 5 losses wipes you out completely. In the volatile 1970s and 80s, a 5-trade losing streak was not just possible, it was common. By capping his risk at 5%, Marcus ensured that even a catastrophic run of 10 losses would only draw his account down by 50%, leaving him with enough capital to fight back. This rule was the safety harness that allowed him to trade for decades. It removed the revenge trading impulse. When Marcus lost a trade, it only cost him 5%. He could shrug it off. He didn't feel the need to win it back immediately because his survival was never in question. This detachment is what allowed him to maintain his mental capital. He understood that as long as he had chips on the table, the next trifecta would eventually make him whole. Risk management wasn't about being scared, it was about being mathematically immortal. Most traders hear risk management and think it means playing small, but for Marcus, the 5% rule was actually the foundation that allowed him to play bigger than anyone else, because once a trade started winning, he didn't just sit on his hands, he used a unit system to scale into a monster. If this breakdown of the wizard's math is changing your perspective on risk, give this video a like. It helps the Growth Archive continue to bring these deep-dive financial histories to light. Point 14. The unit system, the art of pyramiding. The final piece of Michael Marcus's mid-career evolution was the unit system of pyramiding. He never bought his full position at once. Instead, he would break his intended trade into 4 units of 25% each. The logic was simple. Never add to a loser and only add to a winner. Unit 1, 25%. He would enter on the initial trifecta breakout. If the trade hit his stop, he lost 1.25% of his account, 25% of his 5% total risk. Unit 2, 25%. Once the trade was in profit and the tone remained strong, he would add the second unit. He would then move his stop loss on the first unit to break even. Units 3 and 4. He would continue to scale in as the trend confirmed itself. By the time Marcus had a full load, 100% of his intended size, his average price was well below the market, and his actual risk was often zero because his stop losses were set at profit-taking levels. This allowed him to hold massive positions, sometimes hundreds of millions of dollars, with almost no out-of-pocket risk. This is how he turned good trades into legendary trades. While other traders were satisfied with a 20% gain on a small position, Marcus would have a 20% gain on a massive pyramided position that had been built with the market's own money. This combination of the trifecta, tone, risk, and units is what turned a New Jersey psychology student into an $80 million ghost in the machine. But wait until you see the Saudi Rial trade, where Marcus had to put every single one of these rules to the ultimate test against a sovereign government. We are documenting the highest levels of human achievement here at the Growth Archive. If you want our exclusive Market Wizard checklist that summarizes Michael Marcus's 20 points into an actionable PDF, click the link in our description and join our inner circle today.
The synthesis. Becoming the predator. When points 11 through 14 are combined, the transformation is complete. Michael Marcus was no longer guessing where the market would go. He was a predator waiting for a specific set of conditions. He had successfully removed hope from his vocabulary and replaced it with probability. The trifecta provided the context, the tone provided the confidence, risk management provided the longevity, the unit system provided the leverage. This system allowed Marcus to navigate the 1980s, an era of unprecedented global change. When the Plaza Accord was signed and the G5 nations agreed to devalue the US dollar, Marcus didn't just see a news headline. He saw a fundamental shift, a technical breakout in the German mark, and a tone that screamed uptrend. He used his unit system to build a position so large that it single-handedly made Commodities Corporation one of the most profitable firms in history. The philosophy of sacred patience. Marcus often spoke about the sacred position. These are the trades that happen only a few times a year or even a few times a decade. By using the trifecta and the 5% rule, Marcus gave himself the permission to wait. He realized that the average trader loses money because they are bored. They feel they must be active to be productive. Marcus redefined productivity as system maintenance. His job wasn't to trade. His job was to draw his charts, check the news for supply-demand imbalances, and monitor the market's tone. If the conditions weren't met, he did nothing. This sacred patience is the hardest skill to master in the digital age of 24/7 information. Marcus proved that the biggest profits come not from the doing, but from the waiting for the perfect pitch. The psychological rewiring from ego to equity. In his early days, Marcus wanted the market to tell him he was smart. In his wizard phase, he wanted the market to tell him he was disciplined. This is a profound psychological shift. An ego-based trader wants to be right about a prediction. A system-based trader wants to follow their rules perfectly, regardless of the outcome of a single trade. By using the unit system, Marcus removed the all-or-nothing pressure of a trade. If his first 25% unit hit a stop, it wasn't a failure, it was just a pilot unit providing data. This allowed him to stay emotionally neutral. He became a scientist in a laboratory running experiments on price action. If the experiment failed, he moved to the next one. If the experiment succeeded, he added more fuel, units. The geopolitical impact of the 1980s blueprint. As Marcus moved into the mid-80s, the global economy was more volatile than ever. The transition from the Volcker high interest rate era to the Plaza Accord devaluation era was a minefield for most investors, but Marcus's 5% rule and unit system acted as a shield. He was able to catch the massive move in the German mark without ever risking a total wipeout. While many macro funds went bust trying to time the top of the US dollar, Marcus simply followed the tone. He waited for the dollar to stop reacting to good news, and then he used his units to build a massive short dollar position.
This period solidified his reputation as a market wizard. He wasn't just lucky, he was consistent. He had built a machine that could thrive in any environment, whether it was the corn blights of the 70s or the currency wars of the 80s. He had successfully bridged the gap between the individual trader and the institutional force. Conclusion: the master of the machine. Michael Marcus's mid-career was defined by the transition from subjectivity to system. He took the lessons of his father's insurance money, the Plywood Massacre, and Ed Secoda's charts, and he forged them into a trifecta that gave him an edge over the world. He proved that alignment is everything. Don't trade unless the fundamentals, technicals, and tone agree. The reaction is the reality. Watch how the market acts on news, not what the news says. Survival is the primary goal. The 5% rule ensures you are always in the game. Scale for greatness. Use the unit system to turn small wins into life-changing fortunes. Marcus was now ready for the final chapter, the legacy of the $80 million run and the training of the next generation of wizards, including the legendary Bruce Kovner. He had mastered the machine, and now he was about to become the architect of the modern hedge fund era. The following text represents the refinery phase of Michael Marcus's career. This is the stage where the raw psychological scars of his early years were forged into a sophisticated, indestructible defense mechanism. These 4 points, the stop-loss necessity, mental capital, the 50/200 crossover, and objective reality, are the psychological and technical guardrails that allowed him to scale his trading from the thousands into the tens of millions without losing his mind. Point 15. The stop-loss necessity, the pre-contract with reality. In the early chaotic days of the Plywood Massacre, Michael Marcus learned that hope is the most expensive emotion in the financial markets. Most traders enter a position with a plan for what happens if they are right, but they have a complete psychological void regarding what happens if they are wrong. Marcus solved this by making the stop-loss a mandatory, non-negotiable prerequisite for every single trade. To Marcus, a trade without a stop-loss wasn't a trade, it was a suicide mission. The stop-loss is essentially a pre-contract with reality. It is a decision made by your rational, analytical brain before the heat of the battle compromises your judgment. Marcus understood that once a position is live and your money is at risk, your brain shifts from the prefrontal cortex to the amygdala, the center of fight or flight. In this state, a trader will rationalize a losing position, claiming that the market is wrong or that it will come back. By placing a hard stop the moment the entry order is filled, Marcus removed the need for courage. He didn't have to decide to get out when it hurt, the system decided for him. This necessity was rooted in the concept of invalidation. Every trade Marcus took was based on a specific thesis, a fundamental, technical, and tonal reason for the price to move. The stop-loss was placed at the exact price point where that thesis was proven false. If he bought a breakout from a base and the price fell back into the middle of that base, the breakout was no longer a breakout. The trade was dead. By cutting the loss at the point of invalidation, he kept his losses mathematically insignificant, allowing his winning trifectas to pay for dozens of small mistakes. But as Marcus discovered, protecting your bank account is actually the easy part. The real challenge is protecting the hidden currency that every trader carries, a currency that once spent can never be recovered. To survive for decades, Marcus had to learn the art of psychological preservation. If you're building a life where discipline overrides emotion, you belong here. Subscribe to the Growth Archive and help us document the strategies of the world's most resilient minds.
Point 16. Mental capital, the psychology of preservation. Michael Marcus famously observed that a trader has 2 types of capital, financial capital and mental capital. Financial capital is the money in your account. Mental capital is your energy, your focus, and your ability to pull the trigger on the next trade without hesitation. Marcus realized that a string of losses doesn't just drain your bank account, it drains your soul.
When a trader experiences a bad loss, one where they broke their rules, moved their stop, or traded too large, they suffer from psychological drawdown. They become hesitant. They miss the next perfect trade because they are still mourning the last one. Marcus understood that to be a market wizard, you must stay fresh. He would frequently take weeks or even months away from the screens. He owned a ranch in California where he would go to disconnect entirely from the flicker of the ticker tape. This preservation was about maintaining decision equity. Every trade requires a decision, and every decision costs a piece of your mental energy. If you are constantly wrestling with a losing trade, you are wasting the energy you need to identify the next big winner. Marcus's sleep test was the ultimate metric for mental capital. If a position kept him awake at night, it was too large. He would immediately cut the position in half or entirely until his peace of mind returned. He realized that the goal isn't just to be a rich trader, it's to be a rich trader who is still sane enough to enjoy the wealth. Point 17. The 50-200 crossover, the mathematics of regime change. While Marcus's early career relied on hand-drawn charts and feel, his evolution at Commodities Corporation led him to embrace the 50-day and 200-day moving average crossover. This is a mechanical signal used to identify a regime change in a market. In the world of professional trend following, the 200-day moving average represents the long-term trend, while the 50-day represents the intermediate momentum. When the 50-day MA crosses above the 200-day MA, a signal often called the golden cross, it indicates that the short-term momentum has finally overcome the long-term gravity. This was Marcus's signal that a market had moved from stage 1, basing, to stage 2, advancing. He used this crossover as a systematic validation. It removed the guesswork. If the fundamentals were bullish and the golden cross occurred, he knew that the big money, institutions, were now on his side. He didn't need to be the first person in the trade. He wanted to be the person who caught the fat middle of the move. This mechanical signal was his defense against value traps, markets that look cheap but continue to slide. By waiting for the 50-200 crossover, he ensured he was only buying markets that were already in the process of winning. Most people think that these technical signals are about predicting the future, but Marcus knew better. He knew that the charts weren't a crystal ball, they were a mirror. And to use that mirror, he had to face the most painful truth in all of finance, the fact that his opinion meant absolutely nothing. If you're finding this deep dive into the wizard's mechanics transformative, hit that like button. Every like tells the algorithm that the Growth Archive is the premier destination for high-level financial education. Point 18. Objective reality, the ego death of the analyst. The final bridge Marcus crossed to reach the $80 million mark was the total acceptance of objective reality. This is the psychological state where a trader no longer cares about being right. As a PhD candidate in psychology, Marcus had been trained to defend his theories with logic and evidence, but the market is not a debating hall, it is a result machine. Marcus learned that the market is a giant ego crusher. You can have the most brilliant economic thesis in the world, you can be right about the inflation, right about the oil shortage, and right about the interest rates, but if the price is going down, you are functionally wrong. Objective reality means accepting that the price is the only truth that pays. This led to his zero attachment policy. If a trade hit his stop, he didn't view it as a failure of his intelligence, he viewed it as a market fact. He would exit the position instantly, often with a sense of relief. He realized that the market wizard is not the person who makes the best predictions, it is the person who is the most fluid in response to reality. When he traded the German mark, he didn't fall in love with the currency. The moment the tone changed and the objective reality on the chart shifted, he was out. He had achieved ego death, the state where his self-worth was entirely decoupled from his P&L. The synthesis, the architecture of longevity. When you combine points 15 through 18, you see a trader who has replaced bravado with process. The stop loss protected his capital. Mental capital management protected his mind. The 50-200 crossover protected his timing, and objective reality protected his ego. This was the shield that Michael Marcus carried into the 1980s. While other traders were burning out or blowing up during the volatile transition from the Carter to the Reagan eras, Marcus was thriving. He had built a life that was anti-fragile. The more volatile the market became, the more his system excelled. He wasn't trying to outsmart the volatility. He was using his stop losses and mental capital to survive the storms that drowned everyone else. The historical backdrop, the era of the super trend. To understand the power of points 15 through 18, we have to look at the 1979-1980 gold and silver spike. This was one of the most violent periods in market history. Gold went from $200 to over $800 in a matter of months. Many traders went short the whole way up, thinking it was too expensive. They lacked objective reality. They were fighting the trend king. Marcus, however, used his 50-200 crossovers and his mental capital to stay long. He didn't care if the price was historically high. He only cared that the 50-day MA was above the 200-day MA and that his stop loss hadn't been hit. By the time the gold market finally peaked and crashed, Marcus had already exited because the market tone had soured. He didn't lose his mental capital in the crash because he wasn't emotionally married to the trade. He was a professional who had extracted his profit and moved on to the next sacred position. This solidified his role at Commodities Corporation as the lead wizard. He was the one who could handle the most size with the least amount of emotional friction. The philosophy of the clean slate. Every morning, Marcus practiced the clean slate technique. Regardless of what happened the day before, whether he made $1 million or lost $100,000, he entered the office as if he had 0 positions. He would ask himself, if I were not in this trade today, would I buy it at this price? If the answer was no, he would exit the trade immediately, even if it meant taking a loss. This is the ultimate application of objective reality. Most traders are victims of the endowment effect. They value what they already own more than what they don't. Marcus fought this by constantly re-evaluating their existence in the market. He didn't want to own trades. He wanted to rent momentum.
Conclusion: the wizard's final ascension. By the time Michael Marcus reached the final years of his active trading career, he had become a legend not for his gains, but for his grace. He was the man who could lose $1 million in the morning and take his team out to a calm lunch in the afternoon. He had mastered the internal game. He proved that safety is a choice. The stop loss is your only true friend. Energy is a resource. Don't spend your mental capital on bad trades. Math is the map. Use the 50-200 crossover to stay on the right side of history. Truth is the target. Surrender your ego to the objective reality of the price. Marcus was now ready for his final act. Point 19 and 20. The realization of the $80 million blueprint and the passing of the torch to the next generation. He had moved from the Plywood Massacre to the Plaza Accord, and in doing so, he had written the definitive book on how to survive and thrive in the most dangerous game on earth. Most traders fail because they are aggressive at the wrong time. But Michael Marcus didn't just wait for trades. He waited for a specific geopolitical alignment so powerful that he was able to bet $300 million on a single currency. We're going to look at the exact math of that bet. You've heard of Bruce Kovner, the billionaire founder of Caxton Associates. But did you know he was once a cab driver who nearly lost his mind trading soybeans? Today, we reveal the specific curriculum Marcus used to turn that cab driver into a multi-billionaire. Michael Marcus passed away in 2023, but he left behind a secret archive of trading philosophies. By the end of this video, we will summarize all 20 points of the Marcus blueprint, giving you the complete map to $80 million. Join the archive. Before we reveal the mechanics of the sacred position, make sure you are officially part of the Growth Archive. We are building the most comprehensive library of human excellence on YouTube. If you believe that success is a science that can be studied and replicated, hit that subscribe button now. You aren't just watching a video, you're attending a masterclass. Point 19. The power of selective aggression. The art of the fat pitch. In the world of professional baseball, the greatest hitters are not those who swing at every ball. They are those who wait for the fat pitch, the ball that enters the strike zone at the perfect height and speed. Michael Marcus took this concept and applied it to the global macroeconomy. Point 19 of his blueprint is selective aggression. Most amateur traders are aggressive 100% of the time. They use high leverage on every trade, treating a random Tuesday in the corn market with the same intensity as a once-in-a-decade currency devaluation. Marcus realized that this leads to death by 1,000 cuts. To reach the $80 million mark, he had to reverse this. He traded small and boring 95% of the time and massive and violent 5% of the time. The mathematics of sizing, the Kelly criterion context. While Marcus used the 5% risk rule for his standard trades, he understood a concept similar to the Kelly criterion, a formula used to determine the optimal size of a series of bets. The expression is F star equals BP minus Q divided by B, where F star is the fraction of the bankroll to wager, B is the odds received on the wager, the payout, P is the probability of winning, and Q is the probability of losing, 1 minus P. For Marcus, point 19 was about identifying the moments where P, the probability of winning, was so high that F star, the bet size, could be radically increased without increasing the risk of ruin. This only happened when his trifecta, fundamentals, technicals, and tone, aligned with a major geopolitical event. The 1985 German mark trade, the $300 million bet. The ultimate example of selective aggression occurred in 1985. The US dollar had been on a relentless 4-year bull run, driven by the high interest rates of the Paul Volcker era. However, the American manufacturing sector was being crushed by the expensive dollar. At the Plaza Hotel in New York, the G5 nations, France, West Germany, Japan, the UK, and the US, signed the Plaza Accord. Their goal was simple: intentionally devalue the US dollar against the Japanese yen and the German mark. While the world's newspapers were reporting the meeting, Marcus was watching his charts. He saw the German mark break out of a massive multi-year base, 0.9. He saw the price cross above the 200-day moving average, 0.8. And most importantly, he saw the market tone, 0.12. Despite the news of the devaluation, the market didn't just gap up, it held its gains and refused to pull back. Marcus didn't just take a trade, he unleashed selective aggression. He used his unit system to build a position worth nearly $300 million. Think about the psychological weight of that number in 1985. A single tick against him represented hundreds of thousands of dollars in losses. But because the trifecta was perfect, Marcus had the courage to succeed. He realized that this wasn't a gamble, it was an inefficiency. The world's central banks were telling him they wanted the currency higher, and the charts were confirming they were succeeding. He stayed in that trade for weeks, pyramiding his gains, until he had extracted a fortune that exceeded the annual earnings of most small countries. The trap of constant aggression. Marcus often warned that the reason most traders blow up is because they try to be aggressive when the market is choppy. If you are aggressive in a sideways market, your stop losses will be hit repeatedly, and you will spend all your mental capital before the big move even arrives. Selective aggression requires the discipline of a monk. It means being willing to look unproductive for months. Marcus's office at Commodities Corporation was often quiet. He wasn't screaming into phones or clicking buttons every minute. He was waiting. He was trading for the fat pitch. He understood that 80% of your career profits will come from 2% of your trades.
Selective aggression is the ability to recognize that 2% and have the audacity to size up when it counts. The growth checklist. If you want to master the selective aggression mindset, you need to have a clear set of rules for when to size up. We have compiled Michael Marcus's specific entry criteria into a one-page growth checklist.
You can download it for free by clicking the link in our pinned comment. Don't just watch these videos, implement the systems. Point 20. The legacy of the $80 million blueprint, the wizard as a mentor. The final point of the Michael Marcus archive is the legacy of the blueprint. Marcus proved that trading is not a mystical gift reserved for a chosen few. It is a masterable skill. He proved this not just through his own $80 million run, but by successfully training one of the greatest hedge fund managers in history, Bruce Kovner. The Bruce Kovner experiment, turning a cab driver into a billionaire. In the late 1970s, Bruce Kovner was a highly intelligent but struggling academic. He had dropped out of a PhD program at Harvard, worked on political campaigns, and was driving a taxi in New York City to pay the bills. He began trading on the side, famously borrowing $3,000 on his MasterCard to trade soybean futures. When Kovner joined Commodities Corporation, he was a raw talent, but he lacked the guardrails of a professional. He was prone to the same emotional stakes, point 2, that had nearly destroyed Marcus in 1972. Marcus took Kovner under his wing and provided the ultimate mentorship. He taught Kovner that the market is a giant puzzle and the price is the only piece that matters. Marcus's legacy is defined by his ability to simplify the complex. He taught Kovner to undertrade. Kovner's most famous rule, whatever you think your position ought to be, cut it in half, came directly from Marcus's lessons on mental capital. He taught Kovner that the exit is the trade. He taught Kovner that you must know where you were getting out before you ever get in. The global perspective. He showed Kovner how to look at the world as a series of interconnected supply-demand imbalances. Kovner eventually left Commodities Corporation to found Caxton Associates, which became one of the most successful hedge funds in history, managing over $14 billion. The fact that the Marcus blueprint could be transferred from one mind to another is the ultimate proof of its validity. It turned a cab driver into a billionaire because the system was stronger than the individual's flaws. The Global University of Commodities Corporation. Marcus's legacy also lives on through the culture he helped create at Commodities Corporation. This firm was essentially a university for wizards. They hired PhDs, physicists, and psychologists, but they didn't ask them to write papers. They asked them to find edges. Marcus was the lead scientist in this lab. He encouraged traders to archive their philosophies and write knockout papers whenever they lost money. These papers were a radical form of objective reality, point 18. Instead of making excuses, traders had to document exactly why they failed and how they would fix it. This created a collective archive of wisdom that allowed the firm to produce legendary traders like Paul Tudor Jones and Louis Bacon. Marcus proved that a legacy isn't about the money you leave in a bank account, it's about the systems of thought you leave in the minds of others. He democratized the wizard status, showing that anyone with the courage to fail, point 1, and the discipline to follow the 200-day filter, point 8, could build an empire. The final years and the philosophy of freedom. Michael Marcus passed away in March of 2023. In his final years, he didn't obsess over the markets. He focused on his ranch, his private investments, and his family. He had achieved the ultimate goal of the blueprint, total freedom. He often said that being a successful trader takes courage, the courage to try, the courage to fail, and the courage to succeed. But his final lesson was about the courage to stop. He knew when he had enough. He didn't let the greed of the game consume his life. He used the $80 million to buy back his time. For the viewers of the Growth Archive, this is the most important takeaway. The blueprint is a tool for life. Whether you want to trade currencies, build a business, or master a craft, the principles remain the same. Find a mentor, point 6, protect your capital, point 13, wait for the base, point 9, and, when the moment is right, have the audacity to go all in.
If you want to see how a cab driver used these exact 20 points to manage $14 billion, you cannot afford to miss the next video. Click the screen now to watch the Kovner deep dive or check our playlists. Thank you for being part of the Growth Archive. Your transformation starts with the first trade, but it ends with the legacy you leave behind.